Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, make your own financial conclusions, and make your own financial decisions. Today is Wednesday, March 15th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007. And Viper, we are going to chat a little bit this week about the last standing 1% trade that we have open. I'm going to be closing that out this week, and we'll see how that goes. The world of banks is out there, and lots of turmoil and stuff going on in that world. So we'll maybe talk a little bit about that, and then we'll see what else you've been up to in the world of trading. But before we hop to that content, I want to give a shout out to our Discord, link in the description below. You can hop in there and say hello to us. This is also available wherever you get your podcast. If you can't find it there, let us know and we'll get it there. You can also find thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Viper, 1% trades. That is something we've been doing, and we were supposed to come back this week with 1% trade, and there's a lot going on in the market, and I don't believe either you or I put a 1% trade on. And the very last standing 1% trade will close out this Friday. Barring an amazing Hail Mary, which I just don't see happening, so I'm going to call it a full loser at this point, is the trade I made as a $19 scratcher on Citigroup. So ironically, the banks are all the rage these days, but not necessarily in a good way. So you'll see that trade here, 1222 in the center of this chart. Basically, I spent $19 on that long option. It was kind of real cheap as far as expense goes. It's really far out of the money. It was a $55 call. So basically that, had to breach 55 and go above. And yeah, that's just not happening. Citigroup has fallen back. We were pushing there the middle of last week. We were in the mid 50s or lower 50s. And then the banking world seemed to unravel there towards the latter half of last week. And the big banks, which is where Citibank falls, really didn't quite get hammered as much as these regional banks. But the real big one that got all the attention was the Silicon Valley Bank, which is the second largest bank failure in the United States. And I would wager that probably prior to last week, people will be like, Silicon Valley Bank, what do they do? But effectively, they got into a liquidity crunch, and there was a massive run on the bank, which basically just means all the depositors wanted to pull their money out, and the bank didn't really have the ability to fund all the withdrawals. And overnight, on that particular night where everything was really unraveling, before the market opened, the FDIC basically took over the bank and said, okay, we are now running this bank. Everything was kind of frozen. They initially said all depositors that are FDIC insured are fine. You'll get your money on Monday. This was basically a Friday, I believe, that they took possession of the bank before the market opened on Friday. And then they said, oh, and if you're over the FDIC limit, we'll give you a certificate of your debt, but we're not really insured, so we'll have to work that out. And in the process of knocking all that down, the big financial banks came down. So unless Citi makes a magnificent run up $10, that thing's going to expire worthless. So going back to the story unfolding there of the Silicon Valley Bank, then the government came out and said on, I think it was Monday or maybe Tuesday. I'm going to have all my dates. This is going to be one of these things that I didn't get all my facts straight before we recorded. So It'll be like, what are these guys talking about? But the FDIC, or the federal government, basically said they're going to go ahead and guarantee all the depositors of the Silicon Valley Bank. So even though their deposits were not insured, they're going to go ahead and make sure that those funds can come out. And that was good news, because the failure of Silicon Bank really kind of had people rattled, because it was one of these banks that funded a lot of startup companies, a lot of venture companies, small entrepreneurs. It's effectively the type of clientele that the larger banks wouldn't service, just based on either risk or depositor thresholds, limits, things like that. And so they were really kind of serving this whole different clientele of customers. And, with a $250,000 FDIC insurance limit, some of these companies had a lot more than that. And all the bank's assets were effectively frozen, and, they have to make payroll and stuff like that. And these companies, these startups, kind of rely on the liquidity of the bank where they keep their money. And so there was a lot of stories out there of these small startups and things like that. Small, not like 1-2 people, but small, like 20, 30, 100 people companies, where they couldn't make payroll because their funds were all frozen, because the bank had been placed under the FDIC control. And so there was a lot of concern about, what does that mean? What's the ramifications of that? How does that trickle out? And one of the reasons, and I don't know this, concretely, but I believe one of the reasons that the government felt more comfortable kind of backing a lot of the depositors here, in this case, the Silicon Valley, is one of the things, unlike the earlier financial crisis that we had, in 2008 timing, where a lot of the bank's funds were tied up on these high risk assets of, lower mortgage, like low credit mortgages, risky mortgages, things like that, where there could really be the ability that the funds wouldn't come in. What was really happening at Silicon Valley Bank was their funds were all tied up in effectively treasury bonds. So, those notes are in effect guarantees by the government that they will get paid back. They're much more secure than the types of mortgage-backed securities that was involved in the 2008 crisis. The problem was they had all of their funds in these treasuries and things like that, so they couldn't get them out when the depositors wanted to pull their money out. So it was more of the liquidity, lack of liquidity. So when the FDIC is looking at the balance books of the Silicon Valley Bank, they're like, well, okay, this money is not really tied up in risky assets per se. So, we can recover these as these bonds mature, and they can sell them and things like that. And so I think they were more comfortable saying, okay, if we backstop a lot of these depositors and we say, we're going to make sure you have access to your funds, there's some reasoning behind that, because they weren't in this type of asset like the mortgage-backed securities of the 2008 crisis that would just disappear.
Yeah, and there was, along those lines, as far as the T-bills that they were invested in, I believe the more damaging ones were on the 10-year time frame, because, like you said, you can buy these things at different maturation dates, and there was some stuff floating around about why they chose that, because it was like 2021, I believe, when these T-bills were purchased. And some of it was, and this is, I don't think 100% sourced or founded, but there's a lot of information circling around how the messaging at that time from the Fed was that rates would not start to increase until much later than they actually did, late 2023 into 2024. And so that was a signal of, it should be okay then for us to buy these bills further out, because we're not going to get the rate increase, which, as the rates go up, the T-bill value goes down, because there are now more valuable T-bills at the higher rate. So that obviously didn't happen, as early to mid 2022 we hit full throttle on the rate increases. So like Sprocket was saying, all these things the value of all of these assets that the banks had invested in started going down. The clientele that you're serving is very, in some cases, they're pretty fluid as far as needing their money or wanting to withdraw it. And then the news came out that they were tied up in so many of these low value T-bill investments that then started the bank run of we need our money back. So at least as far as what I've seen, that's kind of a lot of what I saw happening.
Yeah, the whole kind of leading up to the bank run was, I guess you could call it a series of unfortunate events, because it almost was like they kind of created the bank run themselves. They didn't really quite understand how the confluence of other bad news would all arrive at the same time. And so I was reading that effectively just before things went south, towards the end of February, they started meeting with Goldman Sachs to basically say, hey, we got a little bit of a problem. We need to basically stop losing money, because what effectively was happening was they had all their money tied up in these T-bills that were paying a low interest rate, but they needed to pay their depositors a higher interest rate because rates had gone up, and they didn't want people pulling their money out because they wanted to offer interest rates that were competitive. So they were effectively had all their assets tied up on a return of a lower interest rate, but they were paying out at a higher interest rate. So that delta, which is normally where banks make their money. So normally banks go ahead and give you a lower rate of savings, then they invest in longer term assets like T-bills and things like that that give a higher rate. And then when they run into trouble is when the rates start to go up. The depositors want a better rate, but they're tied up in these T-bills. So they had a plan with Goldman Sachs to basically say, okay, we're going to sell all these T-bills that we have right now, and then we're going to buy into new ones effectively at the higher rates so they can stop, this cash bleed on their balance sheet. The problem with all of that is when they go to sell those T-bills, they have to book a loss on paper because you're realizing your loss. And so this was going to be somewhere around the vicinity of a $2 billion loss. So what they were working out with Goldman was a stock offering. So they wanted to raise private equity through companies. They couldn't find quite enough companies to pony up the $2 billion. They found a couple of them. So then they were going to pair this with a couple of seed investor companies and then do a public share offering to raise that $2 billion in capital, so that when they went to announce it, they could say, hey, we just took this loss because we're cleaning up our books, but don't worry, this loss is going to be funded by this capital raise that we did out there. So everything is going to be all good. And the plan was effectively, this all had to go super fast, because the other thing that was happening was, because they had this kind of, I'll say it, hole in the ship where they're paying out higher rates than they're collecting, Moody's, which does a bunch of the investment ratings, was going to downgrade them. So when Moody's is going to give a downgrade, the companies usually get a few days, weeks notice that's coming. And so Moody's they don't know exactly when, but they knew Moody's was going to downgrade them. And so the idea was they needed to clean up this hole in the ship before Moody's put their rating out there. So this was the plan that, Goldman had this plan in place, and they had an announcement coming up where Silicon Valley Bank would make their announcement, and they said, hey, look, we're going to book this loss. The shares fell about 8%, which was better than they had expected on the news that they were going to book this, $2 billion loss. The unfortunate confluence of events is, at the same time, after hours, another bank, Silvergate, effectively announced that it was shutting down based on a run that it had against its deposits. And so when that happened, then a lot of the Silicon Valley bank holders started going, wait a minute, this thing just had a run on its bank and they didn't have enough depositors. These guys just booked a loss, or they're going to book this loss of $2 billion. And, oh man, are we at risk? And so they then started withdrawing a lot of their funds, which basically kind of kicked off the bank run there. And so they still had this plan. They still thought this share offering was going to work because Goldman had executed on purchasing the packages of the shares below the trading price of where the stock was trading. So it still was going to provide a value. And so they were going to go ahead and do this offering, raise the capital, save the ship, all this stuff. But the problem was everything started dropping like crazy. And at that point, there was significant changes in the balance sheet at Silicon Valley Bank that the lawyers at Goldman basically said, if you guys want to go through with this share price offering to raise capital, you're going to need to disclose this massive drop in depositor assets, because that is going to be part of the due diligence, or you can't not disclose it at a drop of this magnitude. And as soon as that happened, Goldman said, okay, we can't go forward with this. This was all after hours on Thursday night, I think it was. And before the market opened on Friday, there was no more recovery because the FDIC had taken over.
So, and then picking it up from there, we have, obviously, as many people know on the show, I spend a decent amount of my time just over observing or doing, various things in the crypto land and just watching how things develop over there. And something quite unexpected started developing over there. So if we take one quick step back, there's this concept of something called a stablecoin in crypto. And you're probably going to hear a lot about it as time goes on, especially as the SEC gets deeper and deeper into their trying to clean up regulatory clarity of the space. And the federal government is also pushing for this CBDC initiative, which stands for Central Bank Digital Currency, which is essentially a government-run stablecoin. And so the concept of a stablecoin is pretty simple. You have something that is pegged to the price of something stable. And so in this particular case, the US dollar. So you have multiple stablecoins that are pegged to the price of the US dollar. And so people are like, why would you want that? Why would you want it? Well, because if you want to freeze your investments, if you want to, you just don't want to mess with volatility or something like that. Same thing in your brokerage account. If you hold a bunch of stocks and something's just not going the way you want it to go, or for whatever reason, you want to get back to something stable, you go back to US dollars in your brokerage account. So similar concept in crypto. You want that island of stability. And so now there's all sorts of fun rabbit holes to go down around stablecoins and all sorts of horrendous tales. And so that is a quick flashback all the way back to the whole Terra Luna crash that everybody probably heard about in some way, shape, or form back in May 2022, I believe, where there was a particular stablecoin UST that was algorithmic stable. And so there was an algorithm trying to hold it at $1. We don't need to rehash all of that. But the point of that was just the algorithmic part of it. And then you have other stable coins that are like, well, we'll hold the value of $1 by being backed by XYZ assets. There's a whole thing of ideology behind, well, if crypto is going to be completely disconnected from fiat, then we need to have a stable coin fully backed by crypto, or anything like that. So fast forward now, there is one stable coin called USDC. And that was created by this company called Circle, and their whole thing is they were going to back every single USDC with one single US dollar, and it was always going to be redeemable 1 for 1, therefore pegging the price of the USDC to $1. So I personally, just some of my personal views, I'm all for government-run stablecoin CBDC thing. It's part of integration of this new level of technology in crypto. So I've been a big fan of USDC, and slowly a lot of the space, as other stablecoins have run into issues, especially algorithmic ones, people have started to drift more and more towards acknowledging USDC is pretty stable. So if we can switch to my screen real quick, I want to show some of the things that I really like about Circle and why I've always, quote unquote, trusted USDC is you can see on their website, it's just circle.com if you want to go poke around, but they list, how much USDC is in circulation. So 43.4 billion is in circulation. They also have 43.5 billion in reserves. So this is that backing that I talked about. So 43.4 billion has been minted as a USDC crypto token, ERC20 token, and there's $43.5 billion in reserves backing that. And if we go a little deeper, we can see there's 11.1 billion of those reserves in cash at reserve banks, and then there's 32.4 billion in short-dated U.S. Treasuries portfolio that Circle manages and handles. The other thing they do is every month they provide a full attestament to where the money is and how it is all wrapped up. And you can dig into this. And so this is a decent amount of transparency around this as to why I say, quote unquote, most trusted. And then we get down to the bottom here. And this is where things get really interesting. Make this a little bit bigger. We can see that one of the things about where that 11.4 billion held at banks, they actually list out the banks that they're in here. And all of a sudden we see Silvergate Bank holds they hold their dollars in Silvergate Bank. Silicon Valley Bank.
Bro, I've heard of those banks.
Silicon Valley Bank. One we haven't talked about, and I don't think either of us know enough about to get into, but Signature Bank. This past Sunday, Signature Bank was also taken over by the FDIC, I believe, and shut down. So now all of a sudden, Rorge, something is going on. And so sure enough, Friday, everybody's wondering, what was the exposure? So when Silvergate shut down, they did it voluntarily, and they were very clear of, we're shutting down, we're liquidating all of our assets, depositors will get all their funds, all that kind of stuff. So there wasn't a ton of concern around Silvergate and USDC. However, the surprise nature of Silicon Valley Bank going down and it being listed on this list here, all Friday afternoon, everybody was worried, what is happening? What is Circle's exposure? I mean, there's obviously other banks here, Bank of New York Mellon, Citizens Trust Bank, et cetera, et cetera. So what is the portion of the pot that is in Silicon Valley Bank? And we can see here, if we check Circle's Twitter profile, we can see that they confirm that Silicon Valley Bank is one of 6 banking partners Circle uses, and they also said approximately 25% portion of USDC reserves were held in cash. Just saying all banks make up 25%. They said, while we await clarity on how the FDIC receivership of SVB will impact its depositors, Circle and USDC continue to operate normally. So basically trying to acknowledge the problem, but also we're in this, and we're trying to figure out what's going to happen. And then the big one was following the confirmation at the end of today. So this is the end of the day, Friday, that the wires initiated on Thursday to remove balances were not yet processed. $3.3 billion of the $40 billion of USDC reserves remain at SVB. This is where panic goes wild. So if we look at a chart, this is what a stable coin should look like. I realize it looks pretty glitchy. The spikes are usually just reporting anomalies. If we look at the bulk of the chart here, this is a 0.75% swing above, and that's a swing. The top of the swing is above $1. The bottom of the swing is just slightly below $1. And you go back in time and it's stable because it's supposed to be. So when we go forward, all of a sudden, Friday happens, panic happens, and this thing just depegs wildly. And you can see on the bottom of the chart there is the volume. The volume spike is out of control. Like, this thing dropped all the way down to 90. At peak, it was around 88 cents was what USDC was for a token that is supposed to be $1. That is significant. And so at this point in time, we talk a lot on the show about emotions and trading emotions, and I don't know. I did not expect emotions in this area or how to anticipate how I would feel in a bank run, especially like this, because obviously, as we are long proponents on the show, crypto is not a primary investment vehicle. It is a insanely speculative space. You should not, put bulks of your money into it. So we've acknowledged crypto is not a safe space. However, what was particularly demoralizing in this case is crypto is not a safe space. And the reason it's not a safe space is because the bank is failing.
Plot twist.
And that really messes with you. Because you're like, well, what the heck is this game? Everything is, what is it? What is life? So I did do some panicking around here, and I did book some losses in the crypto space that I didn't need to, but that's emotions for you. The one thing I did was I finally got it together on Saturday when we were around 95 cents, and I was like, look, and I'm telling this story because there's pieces of it that can apply to so many other scenarios, completely not crypto related, completely investing related. I went back to the fundamentals of what is failing right now and what is causing this. And so what was causing this was panic in the market. This is a secondary market. USDC on-chain is a secondary market to the actual refunding of one USDC for $1. And so this is a secondary market panic of the situation. And as I understood the situation, $3.3 billion is not nothing. It was about 8% of the entire backing reserves of USDC. So certainly down, like at the very face value, that fact alone, 8% says 88 cents is way oversold, and this thing should at least be 92 cents on the dollar. That's just the simple math of losing 8% of that backing. However, then there was all the facts about depositors and FDIC insurance. And while this was still down here around 95 cents, it started coming out that Circle made some stronger statements. I think I have them here on their Twitter feed, where they basically said 100% of deposits from SVB are secure and will be available at banking open tomorrow. So that was on Sunday. This, I won't go into it, but they had a blog post here. It was this blog post that came out, I believe, on Saturday, that gave an update of the full situation. They were basically saying, we believe that, well, regardless of the settlement of the FDIC stepping in on SVB, Circle was giving the confidence and projecting that we have enough in our reserves on that treasuries front, because again, you remember the split of what was in the bank and what was in treasuries. They basically came out and said, we have enough. We can cover the losses here. And so I saw that when we were around 95, 96 cents. I was like, all right, here's a quick buck to make, just buy as much USDC as I can. This is an easy arbitrage, quote unquote, easy arbitrage back to $1. So I did that, and so I got, a little bit of a trade win there, but it did not entirely make up for the shuffling around I took in the panic. So there were a lot of lessons learned there that I didn't expect to learn, that I think apply to other places in trading, but certainly apply to when you feel the emotions taking control and the importance of putting a handle on that and trying to push through as pragmatically as possible, because that is something that applies all over the place in trading, as we often talk about.
Yep, always hard to do in the heat of the moment. As prepared as you think you are, like you said, did I ever think that I was going to have emotions in my USDC stablecoin area, and that's the thing. It's going to come up pretty much anywhere where you don't expect it.
Yeah.
So
And honestly, opportunity always presents itself. There were people that were much stronger on their emotions. They saw the FUD coming. They knew uh, they knew there was going to be a risk of depegging. So they actually hedged themselves by going out and shorting USDC. And in the crypto space, there's a lot of places you can short with stupid amounts of leverage. And people were getting ridiculous gains on hedging like that. I'm not saying I recommend that. I'm just saying that's a much more thought out process of acknowledging what's happening. Here's, even on the face, like ignoring how much leverage or what risk they took. It was, here's a situation that's presenting itself. Here's how it likely could play out. And there's all kinds of ramifications when USDC loses its peg. Again, not trying to get into the too technicals of it, but it messes up the pricing of everything in crypto, because all the crypto, like Ethereum, AVAX, Bitcoin, whatever, a lot of that value comes from pairing it with USDC. So when that gets out of whack, everything gets out of whack all over the place. So the opportunity presented itself. Some people stayed calm and predicted, all right, I can hedge the losses on the other parts of my portfolio if this depeg does go south, and I can hedge it with shorting USDC. But that's also a really weird concept, shorting a stablecoin.
yeah, I mean, the other thing I'll kind of mention here, when you're talking about when something's in a state of panic, and everybody's kind of running and screaming, you got a bunch of people that aren't thinking straight. And if you got a level head, you can kind of come into the situation, assess it, and take advantage of that. You can use that, leverage that, exploit that. One of the traders in our Discord was kind of like, they happen to follow a lot of different banks. I mean, banks are things we love to trade too. And he's like, wow, this is some crazy freak out going on with these regional banks. And I mean, this was causing just massive. I mean, some of these things were dropping 50% in a day. They're getting halted on the way down, which sends volatility sky high through the roof. And you start looking at some of these banks and you're like, okay, these are pretty solid balance sheets. And when the FDIC starts coming in and the feds are going to start backing some of this stuff, like all of a sudden, this fear becomes way overblown. And in this particular case, we're talking, there are banks where an at the money premium might be 30, 40 cents normally. And right now, in this state of panic, was almost $3 of premium. And from a option seller, you're going in like, I always joke around when we go to buy insurance, right? You don't buy insurance when the hurricane is hitting you, because when the hurricane's hitting you, it's a little late for insurance. But this particular member of the Discord could swoop in there and say, well, I'm not too worried about this. I'm feeling good about this. You know what? I'm going to throw down some money on this particular option to sell it for insurance to these people that are just freaking out. And as soon as that volatility comes in, which came in like the next day, that day, price went, rubber banded back up 20%, 30%. Of course, it didn't make all its gains back. When you drop, 50% and you go up 20%, you're still down a ton. But that play, he was aware, he understood the mechanics, understood all that stuff, and he was able to come in and make a few good trades.
Yeah, and not beat the horse too much, beat a dead horse even. Just the one word you said there, the mechanics. And that was something that I found in this situation caused me, well, the panic was obviously caused by not understanding the mechanics. What brought me out of the panic just in time to still take advantage of it was the mechanics. The original play that I foofed up and took some losses on, it was a fairly complex play, but I fully understand the mechanics of it. And and it's because of understanding those mechanics that I have that confidence in that play. Had I just had the strength to ignore the emotions of it. And so I certainly, as there's a friend that I have that's just getting into options and all this sort and the kind of the stuff we talk about a lot on here. And I constantly stress, like, don't just rush into it. And we certainly do on the show plenty of times. Don't rush into it until you understand what's happening on whatever you're trading, whether it's crypto, whether it's options, whether it's just buying and selling shares of stock. Understand what you're doing, and that just opens up so much potential for that confidence you need, or that mid-flight panic. When that mid-flight panic happens, you know exactly how to navigate it. You might need to move things around, but you know exactly why or what thresholds you'll need to do that.
So that is just a snapshot, I guess, of some of the latest happenings there. Viper, I think you and I were talking in the Discord about old flame of ours that we had back in the day. Ironically, it was one of our most viewed episodes for whatever reason. It's the SESN is the ticker. And in the episode we recorded, you were in a much bigger position than me, and we dropped, I don't know what it was, 97% or some ridiculous percent in one tick on that particular ticker. We did a whole episode on it. I was like, oh, this is awesome. Let's get back into this and go around again. And of course, we lost again. And then we kind of wrote it off. But you must have gone back to that well. What's going on in your world with SESN?
Yeah, so let's just keep talking about losers. The big loser episode. So if we take a real quick look, I guess, on the chart here, we're looking at that moment that we just talked about. We did a whole episode on previously, where it was running up towards an FDA approval decision. Decision was not good, and flunk. It peaked around 90%, bounced back up, ultimately 70% loss after that. And we did our options thing on it, and rolled that. I don't even remember. It was not a whole lot of money that we put on it. And so then I forgot about it and just kind of let it go. And then as time went on, it kind of cropped back up because it started to find itself, on, now I got to way zoom in the chart because we're way down here, but it started to get into this, spike and dip pattern where we're like, all right, maybe there's an opportunity here. And, PA, kind of shows that it was getting ready to break out. And this cluster down here was kind of where it piqued my interest. And now at least I knew, hair of the dog sort of thing. I was like, all right, I don't trust this thing at all. So first of all, this was the tiniest of, I think it was ultimately like 0.5% of my portfolio, maybe a 1%. But this is not the 1% we advocate on the 1% trades. And it was just a little bit of like, okay, if it pops from here, it's going to pop quite nicely based on, every time it does start to recover, it gets a pop, and then we get out and it comes back down. So I was like, all right, I'll throw up just a tiny literal gamble. And if you'll notice in the center of my screen, this does not say SESN. This is not an accident. It was bought out, which I believe was on Sprocket's bingo card for the future of SESN. And so as this was going, I was like, you can see it started to dip here, and around here I was like, all right, this is not popping. I mean, this was, like I said, it was a gamble. It was lost money the moment I played it. So I was like, we'll just let it go. And then they got bought out, which I don't know. I wasn't following news on this, so I don't know how expected it was. So that's why you can see the price is way different than the last time we talked about it. But they got bought out for around $12 a share. And that certainly, it was around up here. And that certainly did not stop anything. The chart disappears here, and that's because you got to go way down here to find it again, which this looks awfully familiar, doesn't it?
Yes, I've seen that before.
So previously, like I said, it was 90% drop. We stabled out to like 70%. And if we take a look on what happened after hours, so this was no chance to react, no chance to halt even. Uh, we opened up 63, 64% down. And so history does its thing. Pharma does its thing. And it was a reminder why I don't trust this thing. And I was a little mad that I not even trusted it, but that I even thought about it again. But is what it is. I bailed out up here, which is good because it keeps finding the bottom, and it's going to keep going all the way to zero at this point. It's now down 75% from the buyout there. So, yeah, it's a fun time. Fun time.
Yeah, Viper, when we made that trade of SESN, I distinctly remember talking about, all stocks can go to zero, so this could go to zero. And I said, it's very unlikely that SESN will go to zero because it's a pharmaceutical company. Yeah, sure, pharmaceutical companies could go to zero, they could go bankrupt. But most of the time, they have some sort of intellectual property that somebody will want to buy. And if they go to buy it, they're going to offer you some type of share price for it. We were already really close to zero at the time that we put those trades on, like over 1 year ago. And so it was really like, okay, the distance from here to zero is pretty small. So if somebody's going to come in and buy it, it's probably going to be for more than $1. Maybe not a lot more than $1, but hey, we're probably not going to get too in bad shape from it. And so I was looking through the SESN deal, and effectively what was given there was 1 share of the SESN turned into 20 shares of this Charisma. So what the actual numbers were trading for at that time, I don't know. But my guess is it was in the favor of the people that had SESN. So it was just a few pennies or whatever, 20 cents. And now all of a sudden you had 20 times that because it was a reverse split. The other thing of note is as part of the deal, a one-time dividend was paid out to the SESN shareholders of 35 cents a share. So again, we're talking when Viper and I started trading that thing, we were trading it in the 70 cents, 60 cents a share business back then. And so even if we had grabbed a ton of those shares and held on one, we would have been compensated 35 cents a share, so that would have helped a little bit too. But it just goes to kind of show you or to mention that, yes, things can go to zero. More likely cause is someone's going to come in and buy it. Those funds will go to the bondholders, whatever, then the shareholders as part of the deal. So, you never know. This is definitely one where Viper said, "What the heck happened?" And I said, "Pharma, man. I just don't trade pharma. I just don't do it. It's too many weird things can happen. Yeah, some people will tell you, "Oh, I made so much money on pharma," and then I'll show you a dozen other people that are like, "Oh, I lost all this money in pharma."
Yeah.
So,
and it's important to remember in anything, obviously pharma especially, but in any stock, not only can it go to zero, but it can get close to zero, reverse split, and go back up and go again and again and again. And they could just keep reverse splitting until there's 0 shares left.
well, that brings us to the end of this episode. I know we were going to find a 1% trade. This banking thing came in. And from my standpoint, I've just been so busy in things outside of trading and, day jobs and stuff like that, that I haven't really had a chance to sit down and start looking. I can tell you for sure that this is my jam right now. VIX, which is the volatility index, is spiking over 30 in the past couple trading days. This is where there is panic selling going on. And when you have all of that panic out there, this is exactly the time that premiums in option selling are really starting to ratchet up. And, hopefully you've got, I can find something that I'm comfortable with. I know this, and, I'm in a position where, yes, I would be okay taking the risk of insuring some of this stuff in a state of panic, because these swings are very pendulum-like. And when you stretch one way, you're going to rubber band back the other way. And when that volatility climbs up like that, that is the time to start looking out there and scouring for that premium to sell, because there are good trades to be had out there in everyone else's moment of panic, which is why it's always important to keep a nice level head on yourself, so that you can think clearly and objectively when the market is just running around like the world is on fire and not gonna wake up tomorrow. So good luck out there and whatever you're looking for. Hopefully you can keep a level head and keep your emotions in check, especially in times of panic like this, and hope you can find some good trades out there. Don't forget to think outside the block.